Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
All right, welcome to the show. Thanks for being with us. I'm Chris Boyd here with Jeff Perry. We are both of the AMR team at Wealth Enhancement Group, and really happy to have you with us. We've been doing this show for a long time now, and we just love having the opportunity to talk about financial topics, and hopefully it provides you some benefit in your own personal finance journey. And Jeff, it was kind of fun recently. We got some people following up on our offer to send them the checklist, the tax planning checklist.
That's right. The 2024, just for this year. The year is coming to an end.
It's
so
kind of running out. There's a good little checklist for the end of the year. But here, I'll just throw it up. For those watching on video, we can just share. This is essentially all it is. A couple of pages, nothing too, involved, but it's just really as it is a checklist. There's boxes that you can, need to deal with this? Do I want to deal with that?
That's right.
Yeah.
These tax issues, we hope that we deal with them all year, planning and making sure we're taking advantage of different opportunities in the tax code. But really only once a year do people say, okay, it's time to think about taxes. And here we are. So the checklist is really helpful.
Things you can think about doing as you move toward year end to make sure you've kind of got your ducks in a row, and there are times you can either do some things to mitigate your tax burden. And sometimes there's things you can, be thinking about as strategies that maybe that's worth thinking about in a year. Should I do my Roth conversion or, whatever it might be? There's a variety of things.
I had a client yesterday give me a call and said, I meant to contribute. He's self-employed. I meant to contribute the max to my SEP IRA. How much do I have? So I looked it up, sent it to him. He put it in. It's just stuff like that. That.
So if you'd like to get the hand on this, it's really simple. All we're doing is just emailing it off. Just send us an email. We'll send it right out to you. We had a couple last week. Forgot when we talked about it, but must have been in one of the shows about a week ago.
Right.
And it happened to get some inquiries that we had mentioned it. So just threw it right into an email, sent it right out, and got it off to people right away. So if that's something that you could benefit from, you can find the email information in the show notes, but it's amr-info at wealthenhancement.com. And
if you're wondering about if we're going to call you every week for the next 3 years, we're not.
No. Yeah, but it's a good point. That's naturally something people
I know.
If you're interested in newsletters and things like that, we're happy to share them. There's things that we do have as resources that we're happy to share, but don't feel that you're going to get bombarded with stuff like that.
Right.
But happy to share that with you and would welcome that. And, along those lines, just talk about getting contacted by our listeners. Jeff, I recently had an interaction with one of my elementary school best friends, Larry.
That wasn't yesterday.
No, we were connected on LinkedIn or something.
Okay.
And we've been posting the show. He's like, I've been listening to your podcast.
Yeah.
So he reached out, and it's really nice. We got to reconnect a little bit and just catch up. Hopefully one of these days when either I'm in the DC area or he's in the Cape area, that we'll be able to get together. But it was kind of nice. But he was telling me that he's sharing some of the principles that we talk about and with his kids, so his son, I think it was. So in any case, love to hear that what we're sharing is helpful to people and that it can be a resource to them to share with others. We'd really appreciate if you do listen to the podcast. to give us a rating and to follow us. The rating helps other people find it. And so if you can give us a rating, give us a comment, really be terrific. Appreciate it. Thank you for doing that. And then
on that vein,
also be talking about our survey, right?
Yeah, we currently have a survey that we're it's in the show notes of all the recent podcasts. It's an opportunity for you, our listeners, our clients, our friends, our enemies, however we want to categorize you, the people who listen to our podcast, to weigh in on the things that you like, the things that you don't like, suggestions. Just, you can do it anonymously. You can put your name on it. You can put your phone number on it if you want to call.
Yeah. And, of course, if you have a need of some kind, you're always welcome to reach out to us as well. But this is just more, hey, we're interested in what feedback you have. What do you like? What would you like to hear more of? Gosh, we'd love to know. Is it the personal finance stuff you like? You like hearing about markets, and you like hearing about portfolio managers and some of the intricacies of the considerations they're dealing with? Is it more about what are some of the financial planning techniques, and how do I save on my taxes? Or it could be a variety of things. I like to hear what's going on with mortgage rates, or maybe it's more I like those outside people you bring in, some of the charities or things connected to the local story. It's different for everybody, but we'd like to know what our listeners enjoy the most so that we can keep providing that kind of stuff. So.
Right. So we appreciate if you take the time to fill out the survey. And like I said, you don't have to leave your name, or you can, whichever you prefer.
Either way. And look, just as an aside, I don't know about you, Jeff, but I don't love dealing with surveys when I get survey requests. It's like, my time's valuable. So this is very short. It's very succinct. We just want a couple of quick insights if you have a chance to do it.
Yeah. You know why I don't like surveys when I get them is because I don't feel like anybody looks at them.
They're actually being listened to. Yeah.
I had a bad experience at a bank not so long ago. Yeah. And I had to go into the bank and fix it. It was a bank error.
Yeah.
One of the, people make mistakes. I'm not mad at them, but it showed that their systems to me weren't really
sufficient.
Yeah, I feel like a bank should have safeguards that things can't happen, and if they do happen, they should find it before I do. I mean, that's simple, right? So, I get a survey about, we see that you went in, and I filled it out, and the last line on the survey was, "Would you like someone to contact us from corporate?" And I said, "Yes." And of course, this is a month ago, 2 months ago.
You're still waiting.
So when you fill out a survey with a big company, sometimes, you don't feel like anybody's looking at it. And that's how I felt, which made me feel worse than if I had never gotten the survey. Yeah. But I can tell you who looks at the surveys. It's Chris and I.
Yeah. We're interested, and it's coming to us. Yeah.
Right. So if you put your phone number there, we'll call you back.
All right. Good point.
Yeah.
Well, I think the other thing we were going to talk a little bit about was the fact that I had the opportunity not long ago to be quoted in an article. Really was appreciative to that. Corianne Hicks, the author of this article for Kiplinger, quoted me quite a bit in this article, and it was an opportunity to talk a little bit about retirement income strategies. And I think this is something that, we deal with people in retirement a lot.
Yeah.
Most of the time our client, not always, but a significant amount of our clientele are either in retirement or just on the cusp of it, trying to make sure that they're ready, that they have their ducks in a row and are ready to do it. So this article was about the idea of planning for your cash flows in retirement. And so it's an opportunity to talk a little bit about that. So maybe we can spend some time on that topic.
Yeah, I'd love to do that. It was a good article. It's retirement income strategies for the long haul. Creating a retirement income plan is more important than ever, giving our longer lives and the uncertain times. So I'm going to put a link to the article, Chris, in the show notes. So if people want to read the entire article.
Yeah, and there's a lot of good quotes in here from other people as well. It's not just my insights. There's all kinds of good insights in here. So, let's go through some of the kind of things that were discussed.
I love it kind of breaks it down into different categories, but the first category that they focused on is something that, I don't know, if I had to list the 5 most common pieces of advice that Chris Boyd gives his clients, or the 5 most commonly used words. Buckets
Might be on them. Yeah.
would definitely be on the list.
I think conceptually it's helpful for people to think about
very visual, right?
Segmentation of risk in their investment life, and buckets is kind of the phrase we use, and it's not unique to me. Christine Benz of Morningstar talks about that quite a bit, and there's other people before her, but I think it's a comfortable way to kind of think about this notion of segmentation of risk. And as a practical reality, as a practical reality, we think in terms of I don't want all my eggs in one basket, so to speak, right? We know that's
a bucket,
right? Well, we also think, like when we're thinking about people, particularly people who are in retirement, they want some stability, they want some absolutes, they want some certainty that funds aren't going to just disappear due to market movements. And so the idea of having some money in a bucket that's bank money or something that's going to be low volatility, money markets, CDs,
not exposed to the ups and downs of
the market fluctuations, right? So there's how much should we keep in our emergency fund and this absolute kind of return kind of perspective. And I shouldn't say absolute return, because the amount of return fluctuates. It's not about the rate of return. It's about the liquidity, the access, the absolute access to these funds. And so we'll call that bank money, but it could be other things too. But that's kind of the way people think about it, I think. So that's one bucket. Yeah, go ahead.
So I was going to ask you, like, how many buckets should people have? Because you could take this to the extreme where that you say, I'm going to need a new car someday. I'm going to have a car fund. I'm going to have a travel fund.
I had a client do that, actually. She's like planned out, 10 years worth of expenses and was like, so therefore I want to put those aside, and that was maybe too much cash for that amount of. But I do think if you have some expenses that you're planning within the next 3 years, that you're going to want that money to someone buying a house in short order, you probably want that kind of money to be stable and liquid. So that makes sense. We tend to think in terms of what is someone's net expenses as the way to calculate that.
Cost of doing business at your house, right?
Yeah, and this is in retirement that we're talking about.
Right.
But if you're pre-retirement, people tend to think in terms of maybe around 6 months of spending as a good safety net kind of number. People in retirement, we talk about it a little differently. It's not just the gross spending, it's the net cost of that. So if I have a pension and Social Security, and I'll just use easy numbers here, Jeff. So if I have $100,000 of spending and $50,000 of fixed resources coming in, my net spending in this case is $50,000. 100 minus the 50 leaves me at 50. Follow that. So
so that's the number
that's the number I'm
aside.
I want to plan for 1 to 3 years of that amount as readily accessible, retained in my liquid available funds if possible. Now, again, this is rule of thumb kind of thing. And sometimes we find people have net spending that's a negative. That is to say, they have more money coming in than going out. So, then it's a different story, right? It's that formula doesn't work. So then it's more about a peace of mind kind of figure, but not about having this available for the unexpected. And, that unexpected could be a big expense that we don't plan for, or that unexpected could be market fluctuations. And it's not a good time to withdraw from my investments. So I want something that I can draw from with more stability. And I'll refill that bucket later on when markets are more attractive to make my withdrawal, as an example.
Chris, how do you feel about the expected things that can come at unexpected times? So like, I know I'm going to need a new roof sometime. That's going to be 30 grand. I know I'm going to need a new car sometime. That could be, depending on your taste, 30, 40, 50, who knows? I'm thinking about taking a big vacation within the next few years. I know my daughter's dating this guy. She's going to get married. We're going to pay for the wedding.
Yeah.
So
So
these,
all these kind of possible goals. I think some of these are like the car is delayed spending, right? We know we're going to spend it. We just don't. It's a matter of when, right?
right.
But so unless it's within the next 3 years, I'm not going to necessarily say, oh, I have to have that money in liquidity. But as it's becoming more close to that time of the expenditure, I'm going to think more seriously about, is it more important to me to have that money available and absolute than the potential for rate of return I might derive from that or risk that comes with that. You know what I mean?
Yep.
So, but we would potentially have more than one bucket, right? So one bucket is going to be this liquidity bucket. And I think for things that are, I'm taking a vacation, well, that's delayed spending. That's part of your plan.
Right.
And that's probably money that we want to be having some savings for, and be prepared for. But for things like cars that happen every so often, and other expenses that may arise, we might have this this intermediate term kind of bucket, something that's not now, but it's on the horizon. I don't want as much risk as I might have in my retirement plan or something that's long term.
Yep.
I might be more inclined to have something that's kind of in between. Not the full rate of risk I'm willing to take with my long term investments. That may not necessarily be all stock. That may be, I'm a moderate investor and I don't want more than, whatever that implies, 65%, 2/3 or something in risk, or, I'm using an arbitrary, but you get the gist.
Yep.
So I might have my liquidity bucket and this sort of intermediate need kind of bucket. And we think of that generally as being relatively stable, but not without risk. So depends on the person and how much risk that might imply, but, something that's in between.
Yeah, that makes sense. And
because there's still time for that to, percolate and mature and maybe have some good return from that too. But maybe not the same degree of risk we might otherwise be inclined to think of for longer term assets.
Yeah. I think the buckets add just so much simplicity to for some people, this is a complex thing to do. And it just gives people peace of mind, one, but it also gives them permission to kind of spend what they're planning to spend because they have this fund or bucket.
Yeah, and I think you can look at it all together in one sense and say,
absolutely,
okay, in aggregate, how much risk am I taking? But it allows you to be maybe tolerant of volatility in some parts of your portfolio that might otherwise get you anxious, because on another part of your portfolio you've got stability and your means or your needs are being covered without worried about, am I going to be able to pay my bills next month or next year or whatever. So it gives you that kind of cover to feel a little bit of confidence along the way, but maybe do the right thing in terms of staying long term in the way you invest on some of your other parts of your portfolio.
So it's a good transition into another topic in the article. The title of the section is Dividend Stocks and Bonds as it relates to income. So, you mentioned about how you calculate the amount of money in a given bucket, talking about guaranteed income, pension, Social Security. More and more today, people don't have pensions, right? And the bulk of their monthly in retirement, the bulk of their monthly spending is off of their investments, right?
Right.
So there's a old school thought, I guess you can correct me if you don't like that characterization, but to invest in income producing entities like stocks that have dividends or bonds, and then as you're withdrawing from your retirement assets, to take the income, or a big portion of what you're withdrawing is to take the income and kind of leave the principal there. So you're feeling like, I'm not going to run out of money if I'm only taking the income, dividends, interest out of my accounts. Tell us why that's not the best idea any longer.
Well, prior to the last 40 years or something, that was probably of the predominant mindset. Right. And when you look back, we both like Professor Siegel, and he's done a great deal of work on the idea of the dividend and investing, and the way stocks used to generate more cash flow, and that even if you were reinvesting those dividends, you could turn out with big returns. Things have changed over the last 40 years. I don't know, whatever it's been.
Sure.
The way investments tend to be generating cash flow and returns, and value stocks and dividend stocks that we used to think in terms of as the place where people would derive this aren't necessarily without risk, that people used to think they'd be more stable. When it comes to, if you only invested in the more income oriented stocks, you really missed out on a lot of performance. When you think about the rise of technology over that period of time, and the kind of performance that's generated, it's not in the form of income most of the time. It's in the form of capital appreciation. And yes, some companies share that their profitability in the form of a dividend. Other companies provide that in the form of share buybacks and or reinvestment in capital in terms of their product lines and whatever,
acquisitions, whatever, right?
All these kind of things. And so how one generates profitability isn't the same as maybe what it's been in the past. And so we tend to talk to people about a total return perspective. It's not just about the income that you generate. It's about, having total return performance. Some of that's income, some of that's appreciation, and where you derive your spending from it's not as important as, that you have the performance, that broad range of exposure. Now, there's a risk that sometimes people will pursue higher income paying investments to meet their cash flow needs.
Right.
And a lot of times that leads them to be pursuing higher risk investments without realizing it. What do I mean? Think about the bond side of things. If you're buying higher dividend paying bonds, there's higher credit risk involved. There's a greater risk of default. That's one example. If it's on the bond side of things, a lot of times, on the stock side of things, if you buy a company because it's got this really juicy dividend, it's probably because something's been going down with the price of the company, that the yield appears to be so attractive. And will that yield be sustained? Is the company able to maintain that? Oftentimes, juicy yields are generated at the cost of share dilution or other kinds of considerations. We tend to look, or maybe it's narrow sector exposure. It can create some risks that people don't always recognize in the process, and that can be problematic. So, it's worth thinking about. Just as I mentioned, we've been through this, prolonged period where a lot of the performance of the market has been, more dominated by growth kinds of names, and technology and things like that. That may not always be the case, and there may be a move in how things. So it's not necessarily something that's etched in stone, and we have to be tuned into what's happening in the world of the markets and how that might play out for investors in these kind of considerations.
People who have that older mindset of just taking interest in dividends to supply their income sometimes have a difficult time accepting that part of their retirement income is going to be from actually selling underlying shares of a given investment, right?
Yeah, it's frustrating to people. They want to just hold on to it and have the cash flow, that could come from that. And it's understandable on one hand, that is appealing. On the other hand, it's somewhat arbitrary, right? We actually get better tax treatment when we sell capital gains than we do from having dividends.
Right.
And oftentimes with equities, more of our appreciation, more of our return comes from the capital appreciation than it does from the income that's generated. So why are we necessarily limiting ourselves to only the income that it might generate? it's a mindset shift. People don't like to sell. They want to hold on. And if you have sufficient resources, you can do that. But there's a real virtue to the idea that you can use some of the capital appreciation to help finance your needs, your cash flow.
Right. It's kind of the old. I'm using the word old a lot in this episode.
Yeah.
It's kind of the thought of falling in love with a given stock. That I often, when we talk about this issue, talk about the history of AT&T and the stock of AT&T and how so many employees, when AT&T was, the company, had so much company stock and the dividend was very generous, and so many people held AT&T as their source of income through these dividends.
But the business of that, has evolved and changed, right. and who, when you think about what used to be primarily a business of landlines,
right. More of a utility than anything, right?
Yeah, it's changed. And so, and AT&T, as an example, has been in other industries too, in terms of, diversification of some kind, and then found maybe they don't like some of that, right? So, it's had this ebb and flow. It's not the same business it was. And, I remember my dad would tell me that, it used to be that people would think about, utilities as for widows and orphans, that kind of thing, as
cash machines. Yep.
And it's not to say that there's not a place for that, but I think I don't know that you'd say that's the prudent investor anymore. That they'd just be concentrated in that way.
Yep.
And so when it comes to a name like that, the thing to recognize is sometimes that the dividend is juicy, but is the price eroding? And are you subsidizing that healthy, that desirable income with price erosion? Well, how's that different from selling some of your shares? Then if you're some of that's coming out of your capital,
practically the same thing, right?
Yeah. And in the case of different kinds of businesses, sometimes you have an appreciating asset that even though you're selling shares, you're not necessarily eroding your the value of that, the market value of that company.
Yep.
You know what I mean?
I do.
So,
and if the underlying health and potential future growth of that company is declining, that dividend is, while juicy, is probably not going to last. And that's the story of AT&T for decades, and then the dividend was cut,
and
then the stock price went down more. And so
you have to be careful. There's potential hazard in that space.
Yep.
Choose dividend.
While we have a few more minutes, Chris, I want to talk about a couple things that were also in the article: diversified income streams and the use of guaranteed income.
Yeah. So one time, sometimes I'm not sure if this was everything in the article, but sometimes people talk about tax diversification and the idea that we see a lot of times people will really grow their IRA or 401k money, and they don't have a lot in other categories, non-qualified money, your joint account, your trust account, your taxable money, or that tax-free status of the Roth IRA. And
that's what I was thinking, right?
There's a real virtue to having some diversification among these, kinds of income sources. And that can apply similarly in concept to, I want some performance, this income from my investments, but I also want some absolutes, whether it's Social Security and pensions or maybe an annuity income. These are all variables that, it can make sense to have some parts of your portfolio positioned in different ways. We do not advocate for annuities generally. Candidly, frequently we do not advocate for them, but because there's a lot of cost and a lot of they're generally oversold. But there are times when it's a good offering for people to have a portion of their demands for cash flow met with absolutes. And an annuity can provide some of that. And again, there's a lot of details that go into this to find the right product type, and you're giving up some of your principal, and in the process,
and flexibility.
Yep. So whether it's the right choice or not, but that's one of the possibilities. And I think you can't ignore guaranteed income topic without talking about Social Security for most people.
That's right.
And the choices that go into that, there's some real important decision making that people have to be really intentional around. Not just I'm 62, let's turn it on the earliest you possibly could. It oftentimes is not the best solution for people, and
it's really counterintuitive to people though, because there's a spigot there and they're thirsty, so they want to turn it on,
right?
And they think, well, I have some money in even a taxable money. I have taxable money, a brokerage account or savings, and I don't want to use that. That doesn't make sense to use that if I can get it from Social Security. But that might not be the best
long-term outcome. Yeah, it's surprising to people, and I say use this phrase, I guess, but spending more of your money now would allow you to spend less of your money over time.
Yeah,
that by delaying that Social Security and then turning it on at either full retirement age or sometime after that is very likely to be a better choice. Again, depends on life expectancy. If you know how long you're going to live, or you have some reason to think your lifespan is compromised, well, that's a different story. But for people who might have a lifespan that goes past 80 or 81 or something, or if they're the primary breadwinner and it's their benefits that are going to go on to be relevant to the survivor of the couple, then it becomes really relevant to think is either one of us going to live longer than that person's age 81, 82, to defer that benefit to start, and then really maximize the benefit, get more.
Yeah, it's for such a almost everyone who's worked is going to make this decision, but it seems simple on its face. This is how much I get at point A, B, C, or D. It's a dynamic decision that really should be modeled out. And if you're a couple, there's two of you, that adds to it may not be the same answer for both of you either. So
yeah,
you really have to take it as an individual question.
Well, I think and then when it comes to the last point that was in this article, the idea of part-time income can have a lot of virtue for people. And actually, Jeff, when I was getting ready for this, you and I talked about this, and I think you brought this up as one of the thoughts that for a lot of people, it's a great solution. It's social. It's a little bit of cash flow, keeps them going out doing other things to spend their money. There can be a lot of intellectual and physical stimulation that kind of keeps them going.
Absolutely. I don't think most people realize, they think about it, but I don't think they realize the impact of retirement has on your kind of day to day. So, you give up some things that you might not feel are important to you, but they are. You're giving up an identity. You're giving up your work friends who are very social. You're giving up your purpose. You're giving up a routine. Yeah. And you may want to be giving those things up. You may be done. You may be like, I can't do this anymore. I want to get out of here. But by working part-time, you kind of take a transition step, maintaining some of that and earning some money. That's always good, right? And starting to live that retirement life, because it is a big transition for people, and working part-time, whether the same company or whether a different company, you maintain some of that identity, purpose, social connections, and routine that may make this retirement process even better.
Yeah, and to some extent, just that allows you to delay more drain on your portfolio. That every year you do that, there's that much more compounding taking effect, and it can be, somewhat consequential to the impact of your retirement security.
I have a neighbor who is working part-time. She hasn't started collecting Social Security yet, and her comment, she's half joking, but I don't think it's all joking. Is this? She said she's just replacing zeros in her Social Security calculation because Social Security is based upon your 35 years of highest earnings, and if you don't have 35 years of earnings, which many people do, but this woman was a stay-at-home mom for a while. I think she didn't work for 15 years or something. So she's qualified for Social Security, but she's got a lot of zeros in those years. So she's saying she's replacing those zeros with some income, and so therefore boosting her ultimate retirement calculation. Not just by waiting more years to get to 70, if you will.
Yeah.
But by replacing zeros with 10 grand or whatever she's making. Right?
Yeah. It's more than zero.
Right.
So, and I think that's a positive, right?
Right.
So all these possibilities, and of course, there's other people who have, no worries about their cash flows and so forth. They have sufficient resources, but there's still that issue of how am I going to spend my time, and some thought that should go into that. But for a lot of people, it's I'm going to do some consulting and I'll control how much of my time, and they get compensated very lucratively, so it can still have some appeal as a graduated path to that transition into retirement.
And they still maintain their identity and purpose.
Yeah, a lot of those same kinds of aspects, but on their terms, that kind of thing.
Or so it can be really fun to work at Home Depot when you don't have to work and you're just interacting with people talking about tools or
for some people that would be the thing. Other people, Kristen talks about how the people at Trader Joe's are always the nicest people. You got to be nice to work there, I guess.
There you go.
I think of that whoever the guy who or gal who drives people around from the auto dealership, they drop their car off and they get a ride.
They're always happy too, aren't they?
I think that seems like a pretty good retirement.
And they always seem to be like gentlemen in their 70s. Yeah.
Doesn't it? Yeah.
Yeah.
So anyway, well, thanks again to Corianne Hicks for including me in this article. And if you want to check it out, we have a link to it in the show notes. So we'll have that available to you. So in any case, I think that does it for this episode, Jeff. Anything we forgot?
No, just remind people to look in the show notes, not only for the article, to read the article, but if you'd help us learn more about how we're doing, is to fill out that survey on the podcast.
Or the checklist, if you want the checklist. This is probably last week we'll offer it because you won't have much time after this to actually do some of the things in there. So take advantage of any of these resources and help us out with the survey. We'd love that. All right, everybody. Thanks for being with us. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.